Hello everyone, welcome to past paper discussion sessions for advanced audit and assurance exam. In our today's class, we'll be starting discussion on past exam paper for March-June 2026 exam attempt. In this series of past paper discussion sessions, we'll be discussing complete exam papers of around 10 complete exam attempts. And then I will be giving you guys 3 mock exams to attempt on your own and send me for checking and feedback. See, these past paper discussion sessions are really important for your exam preparation in last 30 days because this gives you an idea that how you have to deal with a complete exam paper where all of the topics come together in a time restricted situation. Most of you guys already know me. I'm Owais Mirchawala, your tutor for advanced audit and assurance. I've been teaching this exam paper for more than a decade, and more than 40 of my students have secured nationwide positions in this AAA examination only. So let's start our today's discussion. Today we'll be looking at question number 1 of this exam paper. It will be a detailed session. It will be around 2 hours session in which we'll read the entire question, we'll discuss the points which we have to include in the answer, and then most importantly, we will draft the entire answer, like we'll actually type the entire answer in this word processor document so that you can understand that how actually you have to use these response options in your examination. So now the most important thing throughout our today's session will be your patience and concentration as we move forward. But I can assure you, every past paper discussion session which you take, it will add value to your exam preparation. Okay, so let's start with it. Let's read the introduction screen. It only briefs us that what the examiner has given us in this question. And then obviously the details are given in the exhibits. So it is 1st July 20x5. You are the manager responsible for the audit of Meridian Airways Group. And you are planning the audit for the year ending 30th September 20x5. The group, a leading international airline, is an unlisted entity and is a new audit client of your firm, Equinox and Company. Now, if I read out these 2 lines, the important information is that who is our client? Meridian Airway Group. Who are we? Equinox and Company. But the most important thing is that it is our new audit client. So while we'll be taking the judgment for the materiality level, when we say that it's our new client, so we will consider our risk of audit as higher. So while selecting the materiality threshold, we'll select the lower threshold so that the audit gets more detailed. We'll discuss all of this when we'll be actually going in detail, but this information that it's a new client is really important one. The following exhibits available on the left hand side of the screen, these ones provide information relevant to the question. Partner email, an email which you have received from Neil Sagan, the group engagement partner. Exhibit 2 is meeting notes, summary of the matters including recent financial performance discussed at a meeting between the group engagement partner and the group finance director of Meridian Airways. Okay, then there is recent operational developments, information relevant to audit planning, and then there is exhibit 4, some requests for additional services. See, when we read this introduction, it is just he introduces you. Like in the email, he will tell that what we have to do. In these meeting notes, he said that as he's giving us the financial performance detail, then some recent operational details, and some request for additional services, maybe some non-audit service or something like that. So when we'll read these exhibits, obviously we'll get more detail about what the examiner is asking in them. The information should be used to answer the question requirements within your chosen response options. Okay, so now let's go in detail. Let's read each of the exhibit because that is the thing which will give us more clarity. See, in the examination, when you are reading the question for the first time, it's very important that you read with patience. Try and identify maximum possible data. Don't rush. When you identify things, believe me, every question is easy. It's all about how you approach that question. So let's read the partner's email and identify that what the examiner is saying in it. Okay, so now in the partner's email, it's to audit manager. It's addressed to us. We are the audit manager in the question from Neil Sagan, Group Engagement Partner. Subject is Meridian Airways Group Audit Plan. Okay, date 1st July 20X5. Now, all of this information will be used when we'll be developing the response to the partner email. We'll obviously do when we'll actually draft the answer. Hello. I need you to start planning the audit of the Meridian Airways Group. I recently met with the group finance director and I've provided you with a summary of our discussions as well as information about other recent developments during the year. In line with Equinox and Company internal quality procedures, profit before income tax will be used as the basis for determining materiality. You all know that as per the auditing standard, there are three benchmarks for materiality. It can be revenue, it can be profit before taxes, what we call as profit before income tax, or third threshold is assets. Now, in audit planning questions, in question number one, which is our question one, the examiner always tells us that which benchmark we have to use. Now, for profit before income tax, the range of materiality given by the auditing standards is 5% to 10% of the PBT. Auditor has to use his judgment and select a materiality level from this range. Now, since it's a new audit client, so our judgment will be high audit risk, and the materiality threshold which we'll be selecting is 5% of profit before income tax. We will use all of these comments when we will actually draft the answer. Okay, we have done this a lot of time during our course. I require you to prepare briefing notes for my use in which you, using Exhibit 2 and 3, evaluate the significant business risk facing the group, 8 marks. A very routine requirement in question number 1. Part A on business risk, Part B on ROMM, Part C on audit procedures, Part D on ethical issues. Like I would say, this is one of the most predictable question number 1 format. That Part A, business risk, Part B, ROMM. Or sometimes we just get an audit risk instead of both of them. Then in Part C, there is procedures, and Part D is on ethics, a very routine and expected requirement. Now, since there are 8 marks for business risk, and when we draft the business risk, we consider it as a 2 marks comment each. So we'll have to write 4 business risk in this answer. Then using Exhibit 2 and 3, evaluate and prioritize the significant risk of material misstatement to be considered in planning the group audit. Using profit before tax as your benchmark, you will need to determine and apply an appropriate materiality threshold in your briefing notes. Yes, so while we write risk of material misstatement, the first point is materiality. We talk on materiality as a first point. Then Part C is on audit procedures in respect of the investment in carport company. Okay, we'll read it. That's Exhibit 2. And then Part D is using Exhibit 4, discuss the ethical and professional issues arising from the request made by the group board and recommend any actions which need to be taken by Equinox and Company. So 8 marks for the ethics. So we'll read all of those exhibits. Now, if I just open the word processor document, what the question is asking is to prepare a briefing notes. You can see it. He said, I require you to prepare briefing notes for my use. Now in question number 1 of AAA, in this exhibit 1, in partner's email, he gave us the requirements. If you actually open the requirement tab, it's very much simple. Like just respond to the instructions in the email from the partner, 40 marks. So I heard that question 1 is of 50 marks. Why these are 40? 10 marks are additional. The examiner will evaluate your entire answer and he will see that whether you have answered it in a professional manner or not. Now, what is professional manner? Your communication skill, like you make the format of briefing notes, headings you give, clarity in the answer, whether you are following the instructions of the examiner, like he said that base materiality on profit before income tax. So whether you are following those instructions or not. Analysis, analyzing accounting issues, analyzing audit issues, evaluation, relating it to the scenario, skepticism, questioning, challenging the treatments done by the management, judgment like materiality judgment, correct treatment judgment, and commercial acumen. While you write business risk, that shows your commercial acumen because business risk is business matter. So while you draft this entire answer, you demonstrate your professional skills. Okay. So let's move on. Let's make the format of the briefing notes. Now our question is Meridian Airways Group. Yes, Meridian Airways Group. Meridian Airways Group. Okay. And we are preparing briefing notes. Briefing notes. Okay. Now, while you are preparing these briefing notes, it's very simple. You just go to the question and you pick up the data from here. Whatever approach he gave, just copy it. You will copy it from here and I will go and paste it here. Now what I will do, see, audit engagement partner wrote an email to us. So we were the audit manager, so we were in the two. So now we will switch it because we are responding. So I will cut this from and I will paste it here. And this I will cut and I will paste it here. What I am doing, it was to audit manager from Neil Sagan. So now I switched it to Neil Sagan from the audit manager since I'm replying it. And in the subject, I will just go and I will add RE for the reply. See, these are all exam tactics, exam techniques which you need to understand. The question is Meridian Airways Group. We are preparing briefing notes and now we are writing an introduction. How do we write an introduction? Very simple, very relaxed. In relation to audit planning of Meridian Group, okay, of Meridian Group for the year ended. What is the year end? Now, if you go and look at it, the year end is, it must be written somewhere here. Okay, then it must be written in the introduction. For the year ended 30th September 20x5. For the year ended 30th September 20x5, these briefing notes include evaluation of. Now, what does they include? So, in relation to audit planning of, name of the client Meridian Group, year end 30th September. Or you can write these briefing notes are in relation to, or it's just simple, don't take any stress. These briefing notes include evaluation of what? Just go to the question and pick up each of the required. Evaluation of significant business risk facing the group. This is the first requirement. I will go and paste it here. Now, sometimes in the examination, copy paste function is not working. So there is no issue. Then you have to do the copy paste on your own. These briefing notes include evaluation of the significant business risk facing the group. Further, it also includes what? The second requirement. What is the second requirement? It also includes evaluation and prioritization of the significant risk of material misstatement to be considered in planning the group audit. So I will copy this and I will go here and I will paste it. It also includes the evaluation of significant risk of material misstatement to be considered in planning the group audit. Okay. Then what is the third requirement? Third requirement is principal audit procedures to be performed in respect of the investment in carport company. So include that also. Principal audit procedures to be included in respect of the investment in carport company are also included in these briefing notes. Lastly, briefing notes include what? Just go to the question again. Include the ethical and professional issues, okay, arising from the request made by the group and recommend any actions which need to be taken by Equinox company. So we just need to rephrase this a bit so that it looks like we are responding. Lastly, briefing notes also include the ethical and professional issues arising from the request made by the group board and recommended actions which our firm need to take or need to ensure in relation to the request. Sir, will you repeat it? Yes, I will repeat it. See, when you are doing the examination, it is very important that you understand the approach. See, there are a lot of students who are great in audit, who are doing audit in the companies. But what they mess up in the examination is that they don't know the approach. Like, okay, how I have to write the briefing notes? I just pick up the data from the question, just switch to and from tab, simple. Introduction, just pick up from the scenario. In relation to audit planning of the name of the group. For the year ended, the year end given in the question. Okay. Meridian Airways Group. These briefing notes include evaluation of significant businesses, pick up from the requirement. Then second requirement, evaluation of significant ROM. Third requirement, principal audit procedures. And fourth requirement, ethical and professional issues. So if you look at this introduction, it was completely derived from the scenario. In the examination, you have to learn to save your time. Now, this format of briefing notes which you make, this can gain you 1 mark. And it is not difficult if you have been doing this thing again and again. Now, the part A which we have to deal is business risk facing the group. So, part A, business risk. Now, this is the part A which we will be doing. So now let's go and read this exhibit number 2, because when we read exhibit 2, we'll be able to identify the business risk and then we'll go and start drafting the answer. Are you getting my point? So it's just following the approach, being relaxed and just moving forward. Okay, let's look at it. Okay, so business and financial overview. The group offers flights to destinations worldwide under 3 brand names. Each brand name is a separate subsidiary of a group and a cash generating unit for the purpose of impairment review. The group finance director stated that the group does not believe that there will be any need for impairment to be recorded in current year, despite the changes to the regulation and the challenging economic conditions experienced. See, this issue can be an ROM, that when there are changes to the regulation, there are economic conditions changing or there are challenging economic conditions. So maybe the impairment review is required, impairment need to be recognized, but the finance director is not willing to book it. So this can come in ROM. Okay. And obviously, if there is any change in regulation or challenging economic condition, as we'll read in detail, maybe it can create a business risk also, because challenging economic conditions can lead to decline in profitability. But not doing impairment is particularly an accounting issue. The group has a good reputation for customer service and adherence to the industry's stringent safety regulations. During the financial year, the group has experienced a 20% reduction in revenue across its operations caused by a severe and unexpected global economic recession. So yes, it's a business risk. Similar reduction in revenue have been experienced by group competitor. Fair enough, others are also declining. But if my revenue is falling, global economic conditions are bad. So yes, this creates a problem for my business. Okay. Because, okay, the economy goes in recession and recession, I'm also falling, competitors are also falling, but there will be a time I won't be able to cope up with my cost and things will get problematic for me. Details of revenue and operating result for each of the subsidiary are provided below. Group company Meridian Air, then Meridian Economy and Meridian Premium. They run 3 airlines. The group's main brand flying to over 80 destinations in 35 countries. Revenue and operating profit. Last year, the revenue was 665 million. This year, the revenue is 546 million. So yes, the revenue declined. And if I look at the operating profit, it has fallen from 59.2 to 40.8. So the performance is declining, revenue declined, operating profit declined. Meridian Economy, the group's budget brand, offering cheaper tickets mainly to holiday destinations. Revenue was last year 200 million. This year it declined to 170 million. From operating profit of 4 million, we fell to an operating loss of 1.8 million. And then there is Meridian Premium, the group's newest brand, established in 20x0, offering business class flights to several capital cities. Revenue has got half, because always remember that economic recession hits the luxury class the most, from 80 to 40. Operating profit from 18 to 7.5. So total revenue has fallen and operating profit has also fallen. The group is projected to have cash of $50 million as at 30th September 20x5. The group has access to additional lending facilities of $250 million. The group's profit before income tax for the year is $22 million. Last year it was $70 million. Now the problem is that the performance is like sinking very badly. If I look at the revenue, my revenue was 945. Just think about it, 945, and now revenue is 756. So 945 minus 756 divided by 945. So my revenue has declined by exact 20%. But look at my operating profit from 81.2, it has fallen to 46.5. 81.2 minus 46.5 divided by 81.2. So my operating profit has fallen by 42%. So this means cost is not falling like revenue. Cost is high, revenue is falling. Okay, that's why my operating profit has declined by 42%. And if I look at my profit before income tax, from 70 million, it has fallen to 22 million. Divided by 70, my profit before tax has fallen by 68%. Performance is like alarming. Just don't talk about revenue that okay, revenue fell by 20%. The issue is that my profit before tax fell by 68%. My one of the segment Meridian economy is now in loss. Things are not good. So there is a business risk that the performance is falling. Falling performance of the group. Falling performance of the group. Okay. Revenue of the group declined by 20%, whereas its operating profit declined by how much? We'll recalculate it, and profit before tax declined by 68.5%. Since it's appearing on my calculator, we just did the profit before tax, so I write that first. For operating profit, we just calculated it, 81.2 minus 46.5 divided by 81.2. So our operating profit declined by 42.7%. By 42.7%. So this is a big business risk for them. Revenue has just fallen by 20%, but operating profit and profit before tax have like I would say synced completely. So now when you write the business risk, you identify the risk, you write the impact of the risk, and then you discuss about the scale of the risk, the intensity of the risk, and evaluation comment. So identification of the risk, revenue is declined by 20%, whereas operating profit and profit before tax declined by greater percentages. Falling performance will impact ability of Meridian Airways Group to meet its cost, and it may suffer losses at final bottom line or on final profit before or profit after tax levels. Okay, like the company may go in losses. Okay, global economic recession is impacting the entire industry. However, for Meridian Airways Group, alarming situation is much greater fall in profits as compared to decline in revenue. Okay, like this shows that cost is not declining in that ratio. Okay, Second biggest segment of Meridian Group, Meridian Airways Group, which is Meridian Economy, has suffered an operating loss. So I can say that things are not very much good. If you look at the data, things are not performing well. Okay, like you just have now cash balance of $50 million. So obviously, you have loan situations. Now you will read further also that group has invested in new groups and all of those things. So these particularly indicate that business is not performing in that well manner. Okay. Now further, economic recession will impact Meridian premium segment more severely as luxury products take greatest hit in economic recession. Its revenue has already declined by 50%. If you just go and look at the data, its revenue was 80 million, now it stands at 40 million. So I can say that things are not good. Business risk. What is the risk? The risk is your numbers. Falling performance will impact your ability to meet your cost, to repay your loans. It is impacting the entire industry. But for you, it's a bigger problem because your profits are like falling at a very great ratio. Meridian Economy, which is your second biggest segment, it's in loss. So that's a problem. And you know that this segment should have taken the least hit because when there is economic recession, the people run towards economy. But what we are saying is, in fact, the revenue hit is showing that it has taken the least hit. But operating profit is giving a completely different picture. Like if I take percentage decline from 665 minus 546 divided by 665, Meridian Air's revenue has declined by 17%. Meridian Economy revenue has declined by 200 minus 170 divided by 200. It has declined by 15%, whereas economy should have taken lesser hit. But in terms of revenue, its decline is lesser decline as compared to total decline in the revenue. The loss which it is creating, it's a big problem. From 4 million positive, it's now 1.8 million negative. And the premium, that's very much logical, it will take a hit. Like recession hits the premium segment the most. Okay. So each business risk which you draft is of 2 marks. The approach is identify the risk, think about its impact, that how it will impact our business, and then evaluate it. Like, okay, identify the risk, decline in numbers, impact, we will not be able to meet the cost. Then evaluate it, or the intensity of the risk or the scale of the risk. My economy segment is suffering. Premium is one of my segment, that's luxury. It will take more hit and it has already taken a 50% hit. That's evaluation. Like I am suffering more than the industry. Okay. Now comes the investment they have made in Carport company. In October 20X, okay, now during this year, because September 20X5 is our year end, the group invested $90 million in a newly formed company, Carport company, representing 50% of the share capital of the company. The remaining 50% shareholding is owned by Zenith company, which is not connected to the group. So it's like 50% shareholding. The contract behind this investment states that the group and Zenith company will work together to offer an affordable car park near the main airport in the group home country. Carport company is projected to make $2 million for its first year end. However, customer numbers are projected to reduce in the first quarter of the next financial year. So our new investment, that's also like it will suffer. And it's logical. When airways will suffer, obviously this segment will also suffer. People will park lesser cars. Due to the global recession, the group has not made any operational changes following the investment in Carport company, which is accounted for as an investment at cost in the accounts of parent company and in the consolidated FS. See, this is wrong. It is an accounting issue. When we have 50-50% shareholding, it's a joint venture, and for joint venture, equity accounting applies. Now, what is equity accounting? In the income statement, we record our share of profit, and in the balance sheet, we have to record carrying value of the investment. We have to record carrying value of the investment cost, and then you have to add the share of profit. The group finance director advised that the agreement in place with Zenith Company sets out that each party is entitled to an equal share of profit or loss made by carport company, and each company will have equal representation on the board. Now, see, currently my answer is business risk, but if you want, what we can do is we can just like start listing down the risks of material misstatement when we will draft that part. Like, listen to me very carefully. Obviously, in risk of material misstatement, first paragraph we will write on materiality. Then there will be an issue of impairment of businesses or impairment of cash generating units that we identified at the start of this exhibit. Then accounting treatment of carport company. Okay, like they have recognized the investment at cost only. They have recognized the investment at cost only. In the consolidated accounts, they have to apply equity accounting. So when you are reading the question during that process, yes, you can identify the points which will come like in future answer points, like in the future parts which you have to use. Okay. Obviously, the answer which we are attempting currently is business risk, but if we can find the points for ROMM, we'll just list it down. If you want, you can draft them along with it also. Like for this carport company acquisition, you can write that equity accounting need to be applied. They need to record their share of profit. And then the impairment may also become relevant because in the next year, it's projected that its revenue will decline. So if it's expected that carport company valuation is declined, then maybe impairment will become relevant. Okay. So we have just read this exhibit number 2. We were provided with this financial data. Okay. And this investment in carport company. Let's move forward. Let's read exhibit 3, what he's saying here. Now, aircraft. During the year, the group took delivery of 5 new aircrafts, which were ordered 3 years ago at a cost of $420 million. These aircrafts, which will be used by the Meridian premium operations, have been produced by a single supplier to the group's specification. Okay, they acquired these aircrafts. In line with the manufacturer guidelines, certain components on each aircraft need to be replaced after 8 years. However, it is the group's current policy to depreciate all aircrafts cost over the period of 20 years. Now, this is a problem. In IS 16 property, plant and equipment, there are situations of complex assets where parts of the assets may be depreciated at a different life. So yes, this is a problem. Depreciation of aircrafts. Okay, like in depreciation of aircrafts, with those equipments which have to be replaced in 8 years, we have to depreciate them on 8 years. Like not to depreciate everything on 20 years. This is also an accounting issue. Obviously, this is not a business risk. Now, this is a problem. Like students say that, sir, we cannot differentiate between accounting issue and business risk. I say it's so like irrational. Business risk which impacts my profit, cash flows, like anything which is owner mindset. ROMM is accounting treatments. Like you haven't done impairment or you haven't applied equity accounting or you are depreciating on the wrong line. These will misstate your financials. The expenditure on the new aircraft was financed partly from the cash and partly taking out a 400 million loan on 1st January 20x5 with a 5% fixed interest rate with interest paid annually in arrears. The loan is secured on the group's aircraft assets. No finance cost has been included in the projected financial information. So this is also a problem. Like why they have not recognized the interest cost. Okay, why they are not recording it. So the interest cost which they have not recorded is an accounting issue. Okay, recording of interest cost. Like, okay, when you took the loan, you have to record the interest cost. And coming to the business risk, okay, excessive loans taken by the group. Like, okay, if I just go and look at the performance, or if I talk about the cash flow issues of the group, if you look in the exhibit 2, you invested $90 million. Okay. Then in exhibit number 3, you have spent $400 million on a loan. So, like, okay, your performance is declining, and why you are taking such a big obligations? Okay, so declining performance with so much obligations and cash flow draining, that becomes a problem. Okay, so excessive loans or cash flow burden or cash flow drain, that's a business risk. And lack of recording interest cost, that is an accounting misstatement. Okay, so you can write excessive loans taken by the group, or you can write a point on cash flow issues. Okay, group has taken a loan of $400 million during the year for aircrafts for its Meridian premium economy segment, which is already facing declining performance due to economic recession. Okay, like, okay, this is the risk. When this segment will not generate the funds, how we'll repay the loan? How we will repay the interest cost? Like $400 million at 5%. 5% of $400 million, it's $20 million interest cost every year. Just use your mind. Meridian Premium entire segment do not have that much profit. Its existing profit is not that much. Okay. Currently, Meridian Premium segment is generating operating profit of $7.5 million, which is less than the interest cost of this loan taken, which is $400 million multiplied by 5%. If you show the working, it's completely okay. Otherwise, if you don't show it, that's completely okay. There is no need to show in this way. So you cannot even repay the interest cost. How you will repay the entire loan? Okay. Group's cash flow are already in burden, as they spent $90 million in current year to acquire shares of carport company. Okay, declining performance and burden on cash flow will impact group's ability to survive in times of recession. Fixed interest cost and loan repayments may force the company to risk of bankruptcy. Okay, so yes, this is a risk. You have taken excessive loan during the year. So if you just look at it, see, I'm reading the question in an easy manner. Identify the risk, we talk on that. Nothing pressure on us. Identify the risk, how it can impact us, and anything which creates more problem. Like, okay, our operating profit is not sufficient to even pay that interest cost. You already spent $90 million in the current year. So why are you burdening the company when the performance is falling? This is falling performance, and this is another risk, excessive loans and overburden on cash flow. Now, new regulation. In February 20x6, the government of the country in which group is headquartered and out of which the majority of the flights operate introduced a new regulation impacting on airport. To limit noise disruptions, airports cannot allow flights to depart between 12 a.m. and 5 a.m. In response to this regulation, the group has changed some of its timetables, the regulation particularly affects Meridian economy flights, which often operate during the night when airport charges and other costs are lower. So, yes, this new regulation is a business risk. This new regulation is a business risk. Maybe this new regulation has impacted the financial viability of this segment. And this is well explained here. 200 minus 170 divided by 200. 15% decline in revenue. 15% decline in revenue. But look at operating profit. 4 million to a loss of 1.8 million. 4 million to a loss of 1.8 million. How much percentage this is? This is a 145% decline. 4 million to 0 and then negative. Revenue fell by 15%. Operating profit declined by 145%. Maybe this new regulation has ended the business model of Meridian economy. Are you getting my point? Okay. In addition to this, further regulation affecting health and safety requirements, both for passengers and airline staff, have been implemented, which further increase our cost. Okay. So new regulation. Now this is a business risk. New regulation impacting the flight timings, is becoming a problem specifically for Meridian economy segment, as it is not able to operate flights on cheaper timings, which used to support its budget airline model. Okay, revenue of Meridian economy declined by 15%, whereas its operating profit declined by how much? Declined by 145% and fell to an operating loss of 1.8 million. Okay, so this means that Meridian economy segment is in a problem. Okay, Meridian economy segment is in a problem. Okay, a possibility exists that due to this change in regulation, Meridian economy segment has lost its business model. Like, okay, this is indicated currently due to the fall which is shown. Okay, additionally, new requirements of health and safety also increases the cost of the group, and already declining revenue due to economic recession increases problems for the group. Like, I would say, I'm not doing a lot of research in this question while writing the business risk. The business risks are just ready and they are presented in a platter to you. Like they are easy risks, the apparent ones. Falling performance, excessive loans, new regulation. Are you getting my point? Passenger compensation for flight delays. A number of operational issues in the year resulted in 600 of the group scheduled flights being delayed by more than 3 hours. Legislation in the country where the group is based requires airlines to give affected customers a full refund, and in addition to the refund, pay a compensation of $220 to each affected customer. Now, when the flight is getting cancelled, it is impacting your reputation. And secondly, you have to pay the compensation also. Refund is a lost revenue and the compensation is a bigger cost. Refunds have been issued for all 600 of the flights. However, the group finance director has stated that they do not intend to pay additional $220 compensation to the customer. as he believes that these delays have been outside the group control. The legislation states that airlines do not have to pay the compensation when the delay has been caused by exceptional circumstances outside the airline control. But obviously now this thing will become a court matter. During the year, 115,000 passengers were affected by these delays and have not received $220. Into $220, it's like a very big number, three zeros, then three zeros. It's like 25.3 million. It's like a very big number. It's a claim of $25.3 million. And okay, if this matter goes into the court and it will create a big problem. This has resulted in negative reports in newspapers and on social media from passengers believing that additional compensation is due to them. Many of these passengers have also complained directly to the regulator. So now this is an accounting issue also, and this is also a business risk also. Okay. Passenger compensation for flight delays. Now this is a business risk because it will impact my reputation, and it is impacting. And if I have to pay this 25.3 million, it will like kill us. We don't have sufficient funds. And it is an ROMM because we need to record provisioning. Okay. Provision for flight delay claims. Maybe IS 37 need to be considered here. See, my current objective is not to do ROMM. I'm just, okay, if I find any point, I just go and write in the list. My focus is business risk currently. Okay. Flight delays of 600 flights in the year will impact or is impacting group reputation by great extent. Additionally, failure to pay the compensation, the $220 compensation to passengers is further impacting the reputation. Okay? Okay? Customers who have suffered due to flight delays may not opt for Meridian Airways Group for their future travel, which will impact group's already declining revenue. Impact, or I would say worsen, which will worsen group's already declining revenue. Okay. Additionally, claim of 115,000 passengers of $220 each represent $25.3 million, which is a substantial claim considering falling financial performance already. Okay. If group is found to be unjustified or is found to be responsible for those delays, then these compensations may get payable, and regulator may also impose fine for delaying them without a proper justification. So this is a problem for us. So if you look at 4 business risks which we had to write for 8 marks, like each business risk is of 3 lines. While writing the risk, see, it's not mandatory to follow the approach in the sequence, but while writing the risk, always think, okay, I'll identify the risk. Like, okay, flight delay is impacting reputation. We are not paying the compensation, that is also impacting reputation. What it can do, customers may not travel with us. Then this claim also increases the issue more further. Regulator may get annoyed. So this like scale of the risk, intensity of the risk. So when you read the question, you get the points, like, okay, you just follow the approach. So the most important thing in the examination is like practicing complete exam papers so that your mind is trained for the approach. Like, okay, Business risk, I'll pick up something and put in the answer which will identify that risk, which will create that risk. Now, impact, what it can do up to our business. And then do discussion on it. That what I call as scale of the risk or intensity of the risk or an evaluative comment. Okay. Coming back to the scenario. Fuel cost. The group uses 3 million tons of jet fuel every year. Fuel cost amounts to 30% of the revenue for the year. Due to the fluctuations in the fuel prices, the group uses fuel derivatives to limit its exposure, and latest management accounts recognize total fuel derivatives with a current asset at a fair value of $92 million. See, fluctuation in fuel cost is a business risk. They use derivatives, but that cannot 100% hedge the risk. Okay. But since our business risk are, so now for fuel cost, we can write a risk for the derivatives which they are using. Because you all know hedge accounting may get applicable. Okay. If they are doing proper hedge accounting like hedge instrument and hedge item. Hedge item is the inventory which they actually purchase, and obviously they have purchased the derivatives. Okay. Now it's currently at current assets of fair value of $92 million, but it's a big exposure which they are facing. Okay. Now obviously if the market declines, then maybe the losses may arise. But when you talk about ROMM, it is about the treatment of these derivatives. If they are applying hedge accounting, then the movement of hedge item and hedge instrument is matched. Okay. If these are future purchases for which we buy derivatives, then cash flow hedge accounting become applicable. You know all of these treatments. So you can write a ROMM on fuel cost also, IFRS 9 hedge accounting. So coming back to the scenario, we wrote the introduction. The first requirement was an 8 marks business risk requirement. We did that, 4 risks, 2 marks each. And now we have a comment on risk of material misstatement, which is our second requirement. So let's start doing ROMM also. We'll draft each of the point. Okay. And these are the points which we identified while we were reading the question. Like the primary objective was business risk, not ROMM. Okay. But still, if we need to get more ROMMs, we'll go back in the scenario and we'll find more also. Okay. So let's look at this. Let's start drafting this. Okay. So now we are starting the drafting for risk of material misstatement, and the first point which we will be drafting is on materiality. Okay. So materiality level for Meridian Group audit will be based on its profit before income tax. Now, how do you know this? It was stated in the question. If you remember the introduction screen of the question where in the partner email he stated it, that it has to be based on the profit before income tax. Okay. So, the materiality level of the Meridian Airways Group will be based on its profit before income tax. Meridian Airways Group. Okay. Now, range of materiality level will be between 5% to 10% of its profit before income tax. Okay. Our firm will use its judgment to determine materiality level from this range. Okay. For Meridian Group, it will be between what is 5% to 10% of its profit before income tax. Its profit is $22 million. So 10% will be 2.2 and 5% will be $1.1 million. Will be between $1.1 million to $2.2 million. As Meridian Airways Group is a new audit client of our firm, therefore risk of audit will be high. Additionally, considering declining performance during the year, Meridian Airways Group has greater audit risk. Okay. So when the risk is high, what we do? Considering higher audit risk, lower benchmark of materiality level will be used, and it will be $1.1 million. I will repeat it again. See, this point of materiality which you draft, it worth 2 marks. Now, first of all, you follow the examiner instruction that the materiality level will be based on profit before income tax. Range of materiality level will be between 5% to 10% of its profit before income tax. Okay. Now, for Meridian Group, it will be between $1.1 million to $2.2 million. Okay. I've stated it here along with the range where I stated it. Now, our firm will use judgment to determine materiality level from this range. As Meridian Airways Group is a new audit client, so risk is higher and performance is declining. So again, risk is high because things are not normal. So we'll go for a lower benchmark of materiality. When we go for a lower benchmark, automatically audit gets more detailed because we'll stop at everything which exceeds $1.1 million because then it will start impacting the opinion. So this is a standard approach to write a materiality paragraph, and you have done it in a lot of questions. So materiality level based on the examiner instruction, its range. Now when you calculate this 1.1 million to 2.2 million, you calculated 5% to 10% on the basis of their profits. So each calculation gains you 0.5 marks each, 0.5 and 0.5. Are you getting? And then you used your judgment to give out final materiality level. Okay. Now we'll start writing each of the risks. Impairment of cash generating unit or impairment of each of the business unit. Like the group finance director stated that there is no need of impairment. Okay. Now each business segment, now first of all you will write the correct accounting treatment. Each business segment of Meridian Airways Group operates as a separate cash generating unit. And considering declining performance during the year, impairment review should be done. Impairment review should be done. Okay. Group's revenue declined by 20%, which is due to decline in all of the segments, and profit of the group has declined by how much? If you remember, we wrote in business risk also has declined by 68.5%. Has declined by 68.5%. Okay. Declining financial performance, listen to me carefully, indicates that recoverable amount of the businesses may have declined, and if they have fallen below carrying value, then impairment needs to be recognized. Okay. So the correct accounting treatment, as per the correct accounting treatment, the impairment review should be done, and if the value has fallen, actually the impairment need to be recognized. Now what finance director is saying, group finance director's statement that impairment is not required is wrong, and management must perform a review of impairment before reaching a conclusion. Okay, before reaching a conclusion. Failure to recognize impairment will overstate the profits and assets of Meridian Airways Group. Okay? Are you getting my point? So each business segment operates as a separate cash generating unit. It was stated in the question. It was stated in this exhibit number 2 that they are separate subsidiaries. They are cash generating units. So they should be reviewed for impairment when the performance is declining. Now, finance director says that there is no need. It's not about his belief. The review need to be done, and failure to recognize it will overstate the profits and the assets. Are you getting my point? See, we don't exactly know that how much impairment need to be done, but obviously these are business segments, so it will be material to FS. Now coming to carport company issue. Carport company in which they acquired 50% of the shares. We just read in the question. It need to be recognized as a joint venture and equity accounting needs to be done on it. But they have recorded it at cost. Okay. Investment in carport company should be treated as a joint venture investment of Meridian Airways Group, as they share control on carport company with Zenith company. If you remember, it was stated in the question, they share control with Zenith, 50% shares, and it was stated that we have equal share in profit, loss, decisions and all. For joint ventures, equity accounting need to be applied, under which the group should record its share of profit in income statement and carrying value of investment in statement of financial position. Okay, now this is the correct accounting treatment. Management has recorded this investment at cost in consolidated financial statements. It is a wrong accounting treatment, as it understates group profit and carrying value of investment in SOFP. Okay. See, as per equity accounting, we have to record share of profit in income statement and carrying value of investment in SOFP. But management has just recorded it at the cost. Now, it is expected that in this year it will make a profit of $2 million. It is expected that it will record a profit of $2 million. Now, we don't exactly know the profit, but expected profit is 2 million and the invested amount is $90 million. So, this investment is a material investment to FS. Okay. Now, carport company investment or investment in carport company of $90 million exceeds the materiality level of the group. Therefore, this investment need to be or exceeds the materiality level of the group. Therefore, this investment is material to FS. Okay. So, this investment is material. Additionally, the profit of $2 million of carport company is also material. Maybe impairment review also needs to be considered, because it was stated in the scenario that in the next quarter it is expected that its profits will decline. So maybe impairment review of this investment is also essential. Are you getting it? So what you need to understand is that when you draft the answer, when you write the answers, it's just following the approach. Okay, right treatment, comment on the management, head affected and materiality. Now each ROMM gains you 3 marks, because it's like involving the accounting issues, and it is an easy score. It is an easy score. Now depreciation of aircraft, if you remember exhibit number 3, depreciation of the aircraft, that new aircrafts which we acquired for $420 million, some components in those aircrafts need to be depreciated over 8 years, whereas the group is depreciating them over 20 years. Okay. Now, new aircrafts purchased by Meridian Group for its premium business segment, have some equipments which have a life of 8 years. They should be depreciated separately from the entire aircraft, which group has a policy to depreciate over 20 years. Okay, Meridian Airways, or first of all, if we complete about the equipment, these equipments should be depreciated over their useful life of 8 years. See, this is the correct treatment. When these equipments have a life of 8 years, so they should be depreciated over 8 years rather than 20 years life of an entire aircraft. What management is doing? Management is depreciating entire aircraft, including these specific equipments, over 20 years life. This will overstate its profits and assets of Meridian Airways Group. Okay, aircrafts in consideration, or aircrafts with specific equipments worth $420 million are a material head to financial statements. Okay, now again, we don't exactly know that what is the amount of those specific equipments or what depreciation has to be done of those equipments only, but the problem is the wrong life which they are using. So the materiality of the group, then impairment of cash generating unit, declining performance, carport company investment, we need to record share of profit, depreciation of the aircraft. Like, I believe these are very simple, easy, straightforward risk which we have to cover. Okay, very simple and easy risk which we have to cover here. Okay, then comes another risk which was a very easy one, that they have not recorded the finance cost for the loan which they have taken. Like, how is it justified that you didn't record the interest cost? And in this year specifically, $400 million into 5%, that's 20 million. And in this year, since our year end is 30th September, so January to 30th September, it's 9 months, divided by 12 into 9. Okay, we need to record interest cost of $15 million, which is like a clear misstatement. Okay, interest cost of the loan taken by Meridian Airways Group to purchase aircrafts need to be recorded. Aircrafts need to be recorded for 9 months in the year ended 30th September 20x5. Okay, interest cost amount will be $15 million for 9 months. Sir, how do you know this? It's very simple. 400 million into 5%, so it's $20 million. Divide by 12 into 9, since my year end is 30th September, so it's $15 million. Management has not recorded this interest expense. Like, it's an explicit misstatement, a clear misstatement. Okay, failure to record interest cost will overstate its profits by $15 million. Okay, it is a substantial misstatement, as current profit before income tax is how much? As soon as I will record $15 million, my profit will like nosedive. So it's currently at 22 million. It's currently is $22 million. Okay. Misstatement of $15 million exceeds group materiality level of $1.1 million. Therefore, it is material to financial statements. Okay. So I would say it's like a clear misstatement done in the question. If I look at this answer, it's like very easy and you just need to follow approach for ROMM, correct treatment, comment on the management, what heads are affected. Simple. Then provision for flight delay claims. Okay. Since the people are reporting to the regulator, okay, that some passengers have reported to the regulator, also it was stated here. So we need to think about the provisioning. Okay. Meridian Airways Group is facing a claim from 115,000 passengers of $220 each, which totals $25 million. If I am not wrong, we calculated it. $25.3 million, which totals $25.3 million. Okay. Some of the passengers have reported it to regulator also. Okay. Provisioning of the claim need to be considered if investigation by the regulator has started. Okay, because then current obligation will start. Based on the chances of outflow, a provision may be required as Meridian Airways Group believe that amount is not payable, whereas passengers believe otherwise. Okay. If chances of outflow are probable, then a provision will be required. Okay. The correct accounting treatment. But obviously we don't know the chances of outflow. But we are just discussing that, okay, a concept of provisioning is required. Okay. Management of Meridian Airways Group have not accounted for this provision because finance director believes that it won't be payable. Okay. If a provision is required in this situation, because we also don't know it, but it's a risk, but it's not recognized, then it will overstate profits and understate liabilities of Meridian Airways. Okay. So now, and claim of $25.3 million exceeds materiality level of the group, by the way. So yes, it is also material. Exceeds the materiality level of the group. So if you look at it carefully, like I believe I'm doing this question in a very casual and an easy manner because it is easy. Business risk, falling performance, excessive loans. We talked about the business, the ability to continue. Then ROM. See, in the examination, it's very important to learn that you have to write within limits because you are doing exam in limited time. It's not the examiner answer that you just go on and writing a lot. Examiner answers are very detailed. They can't be done in limited time situation. So you have to ensure that you do it in a time restricted situation. Now, ROMM was of 18 marks. Are we done with 18 marks? Let's look at it. 2 marks for materiality paragraph and 1 mark for this calculation which we have done. Each calculation holds 0.5 each. Lower level 0.5, upper level 0.5. So 2 marks for materiality and 1 mark for calculation. Then 3 marks for each of the ROMM. 3 plus 3, 6 plus 3, 9 plus 3, 12 plus 3, 15. 2 marks for materiality, 17. 1 mark for this calculation. 1 mark when you do these calculations like you commented on the profit before tax. So whenever you do any calculation, like you calculated this interest cost, whenever you do a calculation, 0.5 you are getting for each of the calculation. So it was 18 marks. Narrative has covered 17 and 1 mark can be covered in the calculations. Now comes the conclusion where you will prioritize the risk, that which risks were the significant ones and which were not the significant ones. Okay, so now let's comment on the prioritization of the risk. Now talking about the conclusion. Okay, in conclusion we do the prioritization of the risk. Now if I look at all of the risks, obviously impairment of cash generating unit was a big risk because it will impact the business as a whole. Then carport company thing, recording of the interest cost was an explicit mistake which they did. Provision for flight delay claims was a big risk. Okay, depreciation of aircraft is also a risk, but the point is that this risk in itself, listen to me very carefully, is not an issue relating to the entire $420 million. Some equipments inside it have a problem that they need to be depreciated separately. So what I will do is I will move down this depreciation risk. I will move down this depreciation risk. Cut and paste, Control X and Control V. So impairment of cash generating unit is a big risk. Then investment in carport company of $90 million is a big thing. Then recording of interest cost is a big thing. Now, sir, what about the provision for flight delay claim? This is also a big thing. But see, now here the point is that obviously entire $25.3 million will not come up to become payable. Because we are saying that, okay, we may pay less, their passengers are expecting $220, so maybe a bargain. But always remember that prioritization of risk is a judgmental matter. Okay. Now, most significant risk for the Meridian Airways Group is in relation to its impairment review. As its performance has declined across all segments and all of them need to be reviewed. This is the biggest risk. Now, carport company investment, which is an investment during the year, wrong accounting treatment for investment in carport company worth $90 million is the second most significant risk. Okay. Lastly, failure to recognize interest cost of $15 million is third most significant risk, as it has misstated group profits substantial. Okay, sir, I have a question that if I would have rent interest cost above carport company, would that be acceptable? Yes, that would be acceptable because this is a judgment matter. Okay, like someone may have considered provision for flight claim as a big thing because he must have referred that, okay, in any case, we have to think about $25.3 million. That's also a big thing. So what I always say to my students that whenever you are talking about prioritization of the risk, don't worry in it. Your judgment can differ from another. But whatever you are doing, you should state a reason that why I am considering this as most significant. Okay, impairment was most significant for me because it's affecting all the segments. $90 million investment was a big, and then a misstatement of $15 million. So if I look at my answer till now, see, it's like almost 1 hour and 18 minutes. You have around 1 hour and 40 minutes in the examination to do it. Still, we have 20 minutes. In the class, I'm also explaining it. Obviously, in the exam, you just solve it. You don't explain. We have done 8 marks for business risk and 18 marks for ROM. So what about other ones? See, those are comparatively easy marks. Like procedures is always time saving. Ethics is always time saving. In the class, it takes me around 2 hours normally because I explain also, I repeat also. But in the examination, it's completely possible to complete question number 1 in 1 hour and 40 minutes if you follow the approach. If you don't do excessive writing, if you don't do overwriting. Okay? If you look at my approach, I always keep marks in my mind. Okay, I have to write 4 risks. And with the approach, ROMM, 18 marks I have to cover. I will not miss any mark. I will not write excessive. Now comes the third requirement, principal audit procedures to be performed in respect of the investment in carport company, 6 marks. Procedures is always an easy requirement. It's a time-saving requirement, by the way. So let's look at this. Principal audit procedures which need to be performed in respect of the investment in carport company. Now let's go and read about this carport company investment, and then we'll think about 6 procedures which we have to draft. Okay, so now let's review this investment in carport company because we have to write 6 procedures from it. So in October 20x4, the group invested $90 million in a newly formed company, carport company, representing 50% of the share capital of the company. Now just start thinking about the audit procedures. Now some students say me that sir, procedures seem difficult to us. So okay, let's talk on that. If the group has invested $90 million and then as an auditor, you have to perform procedure on it, what you will do? Like, okay, if someone is saying I've invested $90 million, what I'll do? I'll just go and review bank statement of Meridian, what was the name of the company I forgot? Meridian, of Meridian Airways Group in order to verify cost of investment. In order to verify investment done of $90 million, as it must be recognized as cost of investment in its financial statements. Okay, like what procedure you will perform? You will review the bank statement. What will it verify? It will verify the investment done of $90 million, as it must be recognized as cost of investment in financial statement. So whatever they are saying, just perform the procedure on that. Then read further. A newly formed carport company representing 50% of the share capital of the company. Okay, how do you verify the share capital? Okay, simple. Start with a verb. It's a procedure. Review shareholding structure of carport company to verify Meridian Group claim of acquisition of its 50% shares. Okay, you review shareholding structure. Shareholding structure is a document which shows the details of each of the shareholders to verify Meridian Group claim of acquisition of its 50% shares and other 50% shares held by Zenith company. If you remember, we have already read the question also, because that impacts the joint venture treatment. What else you can do? You can review legal documents to verify cost of investment. Okay. Obtain legal documents like maybe an agreement of investment. Obtain legal documents in relation to investment to verify the investment date of 1st October 20x4. Cost of investment, details of the company in which funds are invested. Okay, as all of these details are disclosed in financial statements. Okay, so when you have to perform the procedure, just be very clear. Like, okay, being an auditor, they said we invested 90 million. Okay, show the bank statement. They said we purchased 50% share capital. Remaining 50% is held by Zenith company. Okay, show me the shareholding structure. Show me the legal documents. The contract behind this investment states that the group and Zenith company will work together to offer an affordable parking. Okay, is there any contract they are saying? Okay, review that contract. Review the contract done between Meridian Airways Group and Zenith company to verify the purpose of investment that they will develop affordable parking near airport. This will impact the financial viability of this investment. Okay, like what are the business plans? So they said that, okay, due to this, we have done the investment. What else? Okay, Carport company is projected to make $2 million profits for its first financial period. Okay, show me their accounts. Obtain draft financial statements. Statements of Carport company for the year ended 30th September 20x5 to verify its profit for the year, as its share of profit need to be recorded by the group. So this is what you do in order to perform the procedures. What else? What else? Let's move forward. However, customer numbers are projected to reduce in the first quarter. Okay, so take their plans, take budgets, because this may impact the impairment review. Due to global economic recession, the group has not yet made any operational changes following the investment in Carport, which is accounted for as an investment in cost. This was the wrong treatment we discussed. The group finance director advised that agreement in place with Zenith company sets out that each party is entitled to equal share of profit or loss, and each company will have equal representation on the board. Okay, now obtain board structure of Carport company to verify that whether Meridian Airways and Zenith company have appointed equal number of directors on board of Carport company. This is essential to verify joint control. So when you have to perform the procedure, it is like questioning everything. 6 procedures hardly take 6 minutes to do it. Review bank statement, review shareholding structure, obtain legal documents, review the contracts done between them, obtain draft financial, obtain board structure. What other procedures? Maybe their projections for next year to verify the impairment reviews of the investment. And then he said that there is an agreement in place which says equal profit sharing. Okay, where is that agreement? Maybe articles of association or constitution of Carport company to verify if there are restrictions on control. So like performing procedures is, I believe, the easiest requirement in the examination. And now comes the last 8 marks requirement, part D. Let's look at it. Ethical and professional issues arising from the request made by the board and recommended actions which need to be taken by Equinox company. Okay, let's look at this. Okay, but for this we need to read exhibit number 4 because it contains detail about the request for additional services made by. Let's look at that. Okay, see, it's all about approaching the question in the right manner, and always the question is easy. Let's read this. Okay, so the group board has advised that following the success of the investment in Carport company, they are now seeking further opportunities to partner with companies in the air travel industry. The board has received a business plan from a food manufacturer with a proposal to create a joint venture focusing on producing high quality in-flight meals. The board would like Equinox company to review the business plan and confirm that this is a suitable investment for the group. So this will create a self-review thread, because if we review an investment, that investment will become part of consolidated FS. So either it will become a self-review thread for next year, or in the current year it may become a subsequent event, because it is not the work of an auditor to do this. Okay, so if we start listing down the points, there will be a point in relation to self-review thread. Okay, If the proposal is approved, the board wants to move forward with the investment as soon as possible and has approached their lender about obtaining additional finance. The bank has confirmed that they will consider the financing, but would like to schedule a meeting with the board and Equinox company to discuss the work on the business plan and to answer questions they might have prior to offering the finance. So if we are attending the board, the meeting with the bank, it creates advocacy threat. It is like accepting responsibility of management work. Okay, like business plans and all is the management work, it is not the auditor's work. The group finance director that there should be no issue, as this work would obviously be carried out by a separate team to the audit team. Okay, yes, separate audit team will reduce self-review threat, but it will not reduce the advocacy threat. It's advocacy of the firm. So separate team will reduce threat of self-review. Like, okay, separate team doing this work and audit is done by someone, some other team. But audit, the advocacy issue won't reduce because it is still the same firm. And that carrying out additional work would be a good opportunity for Equinox company to demonstrate why they should retain the audit work. He is giving you a slight indication that, okay, agree with us or you may lose the audit. So he is creating some sort of intimidation threat also. Like, okay, just see the words, why they should retain the audit work. So, okay, you are intimidating me, you are giving me an indication that maybe we may lose the audit. The board also mentioned that they also offer the audit firm discounted travel on flights operated by any of the group subsidiaries. So gifts and hospitalities, it creates self-interest threat. Okay, so we have to politely decline this gift and hospitality thing, gifts, and we have to politely decline this additional work also, because advocacy threat will be substantial enough. It's an 8 marks point question, so you have to cover 8 marks, including issues and the recommendations and all. Why self-review threat? Self-review threat will be created if our firm assists the group in reviewing their investment plan. Okay, as investment in, what's the name of that company, as investment in this food sector, the board has received a plan with a proposal to create a joint venture on focusing this food plan. Okay, the name of the company is not given, that what that company is. As investment in food sector will become part of Meridian Group financial statements in next year or maybe in current year, subsequent events, our firm will face self-review threat while doing audit of this head, as our firm itself has been part of its investment plan review. Okay, like that becomes a self-review threat and a logical self-review. Self-review threat will be created if our firm assists the group in reviewing their investment plan. Okay, because then later on, if the things are not good or if there is any impairment review required, we won't be able to say that, okay, the investment is not good. They will say that, okay, you yourself said that it was good earlier. Will become part of Meridian Group financials in next year or maybe in current year, subsequent events may be in form of a disclosure. Our firm will face self-review threat while audit of this head. Okay, while performing audit of this head, as our firm itself has been part of this investment plan review. Additionally, request to attend a meeting with the bank where bank loan for this proposed investment will be discussed will create advocacy threat for our firm. Okay, in dealing or in meeting with the bank, our firm will have to advocate, support, will have to advocate investment plan of Meridian Group in front of the bank so that bank loan is approved. This will compromise independence of our firm as advocacy threat will be significant enough. Okay. Further, attending a meeting with bank and answering their queries is a management responsibility. Okay. If our firm is involved in this process while being an auditor also, then it will be like accepting management responsibility, or it will be like accepting responsibility for management work. Okay. Objectivity of our firm as an auditor will be compromised. Okay. Because there are management responsibilities and there are auditor responsibility, and you write them clearly in the audit report. So arranging finance, dealing with the bank, business decisions, these are management responsibilities, not the auditor responsibility. Use of separate team as referred by finance director is a good safeguard to resolve self-review threat. Okay, that a separate team will do audit and separate team will review this investment. However, advocacy threat and threats due to accepting management responsibility by our firm will not be resolved due to use of separate team for audit and for this investment assistance. Okay, like use of separate team is good, but it won't resolve this matter. Intimidation threat is also created in statements of finance director where it is stated that if Equinox company will accept the request of the board of Meridian Airways, it will help our firm prove that they are right firm for next year audit. Okay, it is an intimidation that our firm may lose next year audit if request of Meridian Group of board is not accepted. Such intimidations compromise auditors' independence. Okay, so like very easy 1 mark when you are dealing with these ethical and professional issues. Write small comments, deal with 1 mark, okay, and just move forward. Are you getting my point? And then self-interest threat. If we look at this issue where he said that okay, they will offer discounted travel on flights operated by any of the group subsidiaries. So offering such thing to audit firm is a self-interest threat. Self-interest threat may arise or will arise due to gifts and hospitality. Due to gifts and hospitality behavior offered from the board, where they stated or where they offered that auditor can have discounted travel on Meridian Airways Group. Okay. Any favor or any discount, any favor given to auditor due to his role as an auditor may impact auditor's independence, as it will create self-interest of the team to consider, I would say, relaxed behavior or to consider favorable behavior for the client. It will create self-interest, right? It will create self-interest of the team to consider favorable behavior for the client. Okay, so you identify the issue and you simply explain it like how it can create problem. Our firm should politely decline, okay, gifts and hospitality offered by the board, okay, so that issue of self-interest threat can be resolved. Okay, we can say like, okay, we can't take it because these things can create self-interest threat which cannot be reduced easily. Okay. Lastly, request of the board to assist in reviewing the investment and accompanying in board meeting or in the bank loan meeting should be politely declined, as it will create a significant threat which cannot be reduced through safeguards. Okay, like it will create a significant threat to independence. Like if we attend the bank loan meeting, like when you attend the bank loan meeting, it is where like the safeguards can't work at that time. Independence which cannot be reduced through safeguards, and like answering the questions of the bank. And then obviously there's statements like, okay, they are rushed in the loan and they expect that we'll get it done. So apparently they will continuously pressurize us during this engagement, during this process. So if you look at the answer, see, many students say me that, sir, we are in the audit firm and all. So do you think that we should go for AAA paper? I say, okay, you are in the audit firm, you have a good knowledge of audit, you have covered book and all, everything. But in AAA, at the end of the day, the important thing is the exam approach, which you learn when you do the past papers with the teacher. Because you have to complete in time how you write business risk, how you write risk of material misstatement, then procedures like how you develop them, then ethical and professional issues. Okay. And one important thing, like if I show you the examiner answer, because I want something to show you from that. Yes. Okay. Let me make the file visible. Yeah, I think now it is. Okay, just a second. Yeah. Now, if you look at the examiner answer, what you need to understand from here, what students normally do is like when they look at the examiner answer, what they do is they read like this. They say, okay, sir, see, the answer is so detailed. Okay. The answer is so detailed here. He has given so much detail and we are writing so short. So how will we get the marks? Okay. See, here what you need to understand is that this examiner answer is not written in time restricted situation. You cannot write this much in 15 minutes. For 8 marks, you have around 15 minutes, and that 15 minutes also include thinking time. You have to think and read also in the examination. So yes, you read these points, but then scroll down and always go and read the marking scheme. See, this is the marking scheme. Now in the marking scheme, go and read what he is giving the marks here. Self-review thread, 1 mark. Advocacy thread, like you explain it briefly, it's a 1 mark point. Management responsibility, reviews by independent partner to reduce the threat. Firm might be able to offer feedback or analysis, but the responsibility should be of the management. Intimidation threat, when they said that, okay, this is the only way to prove that you will get next year audit. Discount offering is creating a self-interest threat. Okay. conclusion. So this is the marking scheme for which you are evaluated for the mark. Similarly for the procedures, similarly for the risk. So yes, you can read the examiner answer as a guide. Examiner answers are very detailed, and it's impractical to write this much for 2 marks. Like you are saying me write this much for 2 marks. This is not practical. So always keep marking scheme in the mind. And then the answering approach which we follow in the class, it is as per the examiner articles. Okay, examiner has given technical articles like how you have to draft the answers in the examination. Okay, so it's important in the examination that you follow the approach, you understand that how much you have to write it. So today we are done with question number 1 of this question. In the next class, we'll move forward. We'll look question 2, question 3, and so on. The series will go on. We'll be continue doing complete exam papers. And that's really important to improve your chances to pass the examination. If you have any query, you can always connect me directly on my WhatsApp number. Okay, my number must be appearing on our channels also. Otherwise, this is my number. You can always connect with me if you have any query or anything. Most of you guys already have my number. If you don't have, you can just note down and you can contact. Okay. Thank you, everyone. And I hope to see you all in the next class. Thank you.